All righty, everybody. Welcome to Talking Real Estate here at Champions Real Estate Team at Berkshire Hathaway Home Services Ambassador Real Estate Company. My name's Mark Wehner II, and every week we jump on here and talk about what's going on in the real estate market. And you hear my coworker in the background. She decides to get a little chatty Cathy on us as we go live. But so every week we jump on over the lunch hour, give you kind of rundown of what the numbers are doing, what our kind of take is on the market, and try to keep it short and sweet for you. So let's jump straight into it. So similar song and dance to the last couple of weeks. So we had 316 new listings go live in the last 7 days. We had 370 new contracts written in the last 7 days, and we had 353 new homeowners. So congratulations to them on winning the bid, essentially, in our kind of crazy market. So as you can see, we have more contracts written than new houses, that came on the market. So the market absorption is going very fast. We're absorbing those homes as they come on the market. We are seeing a lot of homes, not even necessarily get to the market before they're sold. So that's another reason why teaming up with Champions Real Estate Team here at Berkshire Hathaway, we kind of get the word out of when homes are coming on the market, before they do hit the market. And the one thing that we have an advantage of having the largest market share at Berkshire Hathaway is essentially the broker exclusive listings. When an agent lists a broker exclusive, they can only market to that brokerage that they work with. So if I list a house as a broker exclusive, I can only market it to Berkshire Hathaway agents. And knowing that we have one of the largest buyer pools with our company, maybe that's an advantage. There's pros and cons to each situation. So, but that's something that we can hopefully find you a house before it really goes out to the entire marketplace out there. So share kind of the big 30,000 foot view here. Let me pull it up as it pulls up here. So we have 1,122 active listings in the Omaha and Lincoln MLS, and breaking it down in the Douglas-Sarpy County, 544. We have 185 existing home listings in the Douglas and Sarpy County area. So as you can see, with a population over, a 750,000 million with a surrounding area, 750,000 people, we have 185 existing homes for you to take a look at today as of about 10 o'clock this morning. So, that's not a lot of homes. New construction, we're just under 360 there, less of a month supply of inventory. 296,000 is the average from this quarter to last quarter. It's up 14% from last quarter. This month, when I looked, the average sale price was 305,000 just in the month of March. That only takes a small sample size of that, but the quarter from January to March of this year is 296, up 14% from last quarter or last year at this time. So as we can see, the market prices are going up. Russ and I were just kind of chatting before we got on here. So yeah, Russ Williams is joining me with Williams Mortgage. We were just kind of chatting on, kind of what mortgage rates are doing. We're seeing them kind of peak and valley, on more going on the peak side here. And, it's kind of a shock to some of those buyers that may have, been looking for the last couple of months, and all of a sudden they talk back with their lender, which I encourage you to do, is stay in contact with your lender, what rates are doing, because that's going to affect your purchase price, on what your purchasing power is, and ultimately your monthly payments in that regards. But as we touched on in previous weeks, is as you can see, the prices have just steadily risen over the last couple of years, and just kind of a simple supply and demand. So even though interest rates are up a little bit, prices are still competitive, and they may be going up as well. So buying a house now may be advantageous than waiting a year to see, what's interest rates going to do in the next year? Well, maybe they're at 4.5%, not up to 5%, but next year you're at $250,000 house, maybe at 275. So you're up 25 grand on a purchase price, even though the interest rates may be hovering in, within a percentage of where they're at today, maybe up or down. We don't necessarily have the crystal ball, but that's just something, when you're looking at it from a big picture standpoint, is don't get so mesmerized in what's happening in today. Think about what's going on in the future. Where do you want to be in the future? What do you want to do with the property? Are you going to stay in it for 30 years? Are you going to be there for 5 to 6 years? Are you going to keep it for a rental property, investment property, all those kind of fun things? And that's all stuff that we can kind of help and coach you and see what's the best avenue for you to do that. So I guess, Russ, I know we touched on rates a little bit. I guess what are you seeing, kind of in the last week since we've last chatted?
Yeah. As we talked about previously, we knew the Federal Reserve Bank was going to be raising short-term rates that affect things like credit cards, student loans, and auto loans. And in a normal market, that might actually have improved or helped mortgage rates to stabilize and maybe even improve just a little bit. The reason why they didn't is because the Federal Reserve hasn't been totally clear on when they'll be starting to reduce their balance sheet. We've talked about that in previous sessions, and if anybody has any questions, they're more than welcome to reach out. But Mark, something you mentioned just a moment ago is very important. Yes, interest rates are up, and yes, borrowing power has deteriorated because interest rates are up. But if we look at all the technical indicators out there, this is a pattern that's repeated 5 times since the late 1970s. And each time as we've seen inflation start to rise, we've seen the Fed start to react. Unfortunately, they're not as proactive as what we'd like for them to be. And this pattern is set up almost to be a perfect repeat of something we've seen 5 times since the 1980s, which would suggest that we are on the cusp of a recessionary period. And if you think about it, Mark, we know that energy prices are up. Every time we fill the gas tank, we know that. We know that food prices are going to continue to rise. Of course, Ukraine produces 30% of the wheat that the world uses, and so that's going to affect the cost of anything that has flour in it. Other consumer goods are up. Ukraine, for example, is one of the leading providers of neon, which is used to make computer chips. Just last week, for example, the Shenzhen region of China shut down with COVID. And the city of Shenzhen is a large producer of computer chips. That's going to further potentially disrupt supply chains and push prices higher. We know that inflation is at 40-year highs right now. Those are as of the February numbers before the war and before all these other things that have happened. So we're likely to see inflation, quite likely, almost a guarantee, as a matter of fact, to see inflation numbers be higher in the months of April and May. The Fed, of course, is acting and has indicated they intend to act aggressively to get inflation under control. All those things are playing into this pattern that's repeated itself. And we expect that we probably will see a recession sometime anywhere as early as maybe late this year into sometime in 2023 or 2024. Historically, every time we've hit a recessionary period, once inflation is starting to become under control, we see mortgage rates improve a little bit. I don't say that to suggest that you wait to buy a home next year or the year after, going back to what you said earlier, Mark, because even though rates may be lower down the road, you may be buying a home that's significantly more expensive. If you're watching the news has been talking about expecting the later part of this year to see sales down on real estate. Part of the primary reason why sales are down, just as you had shown in the graph a moment ago, is there are fewer homes for sale. We can't have an increase in sales if there are fewer homes available to sell. So it's important to understand the big picture, work with a team like Champions that can explain it to you. I highly encourage you to buy the home at today's price and refinance down the road. You're not going to, to your point, Mark, if you've picked up $10,000, $15,000, $20,000 worth of appreciation over the next 12 to 18, 24 months, whatever the period of time may be, it's certainly not going to cost you that much to refinance, but you won't owe nearly as much on the house as you would if you waited until next year or the year after.
Yeah, and that's the other thing too, is we were talking about a little bit before we jumped on, is kind of just rent prices too. With those interest rates going up, and if you have real estate investors buying houses, their mortgage payment goes up, so in turn the rent goes up. So those $1,500 a month rental payments may jump up to $1,750, just for the simple fact that those investors, they're not going to do it to lose money in that regards, because they have their cost of maintaining the property management, all the kind of costs, the taxes, and all that stuff that goes into it, the insurance. But those are some things that if you are still considering doing rent, if you are renting a home, and if your lease is going to be coming up in the next year, that's something that your landlord may be looking at increasing that, because as we also talked, property valuations have been going up because was it Diane Badiato just got on in the article a couple weeks ago that basically they have to be within the law, as market values go up, their valuations, their assessment of the property has to go up, and so all that goes up. That's all going to trickle down to those unfortunately, those renters in that situation. So those are some things that, as we kind of maybe potentially come into a recession, that taking that money and trying to get your foot in the door, to buy a house so that you can recoup some of that and not be, putting money in your own pocket, building your own equity, and hopefully capitalizing on that appreciation in your house. And then as you gain that equity, you can use that equity, that if you do have debt or stuff like that, you can pay that down. And, depending on what the interest rates are, if you have credit card debt with those rates, the Fed's raising those rates on credit cards, pay it, there's different ways that you can structure it, and that's what we're here to try to help you with, and coach you through that. Essentially is here's some options. What makes sense to you? And I know we've talked on with investors is if you have a house, you can take out 75% of that equity. If you want to move up or move down, and buy a next house, keep your current home as a rental for another stream of passive income, and then you have the tax benefits and the write-offs and all that kind of fun stuff that goes along with it. So there's a many different spokes in the wheel. We just want to help you ride the bike, and get to where you need to go in that process of it. So we want to keep it short and sweet. So I know we touched on a lot of things with the rates and what the market's doing. As always, we're here to help you. So give us a holler anytime. Your Champions Real Estate team, give Russ a holler as well. Reach out to us on any of our social media platforms, like, share, all that kind of fun stuff, on our YouTube page, and all that good stuff. So, Russ, you have anything else you wanted to add?
This is great stuff, folks. Listen to this a couple of times. There's a lot of information here, and it's important for you to understand it.
Yeah. I think there's a lot of stuff we can, I know you sent out an email to us at Champions Real Estate team yesterday, just about, it was a lengthy email of what's going on, what, the reactionary things, if this happens and that happens. And I think it's a great tool for us as agents to stay on top of it, but ultimately coming from a source like you, that's very on top of it, keeps everyone informed, and those that work with you, your clients, they're going to be well informed on, so they can make a good decision. So I appreciate you sending out those emails. And if anyone wants those emails, I'm sure he's happy to send it out to them. So shoot him an email. Reach out to him, and he can get you on that he kind of does about, once a month or so, just if there's something major that happens, and just kind of keeping us in the loop on what's going on. So that's what, anytime you're doing anything, surround yourself with people that can really help you, whether that's in real estate or in your professional careers or anything like that. So that's what we like to do here. So anyways, have a great rest of the Wednesday, and we will catch you guys on the flip side. So see you next week, and take care.